January 2025. Japan's 10-year government bond yield surges to 1.3%, the highest level in 27 years. The 30-year yield jumps to 2.9%, and 40-year bonds cross 3.1%, levels unseen since the 1990s bubble era. The mainstream financial media reports this as routine market volatility, perhaps a sign of improving Japanese economic prospects. Bond market professionals notice something different. Within days, auction results show pockets of weakening demand. Foreign buyers reduce participation, domestic banks hesitate at expected yields. The Bank of Japan, which owns over half of all outstanding Japanese government bonds, faces an impossible choice: intervene to suppress yields and risk reigniting inflation, or allow yields to rise and watch the world's most indebted government face exploding debt service costs. Here's what the routine yields rising coverage misses. Japan's government debt exceeds 230% of GDP, the highest of any major economy. The proposed fiscal stimulus package, including income and corporate tax cuts championed by politician Sanae Takaichi, could cost approximately $5 trillion annually in lost revenue. When bond markets doubt a heavily indebted government can fund unfunded fiscal promises, yields don't rise gradually, they spike. And when they spike in the world's second largest bond market, the stress doesn't remain isolated in Tokyo. This isn't about whether Japan headlines are dramatic. This is about recognizing when funding plumbing breaks, and understanding that higher global yields don't stay in Tokyo. They show up as tighter credit, higher mortgage rates in the US and Europe, and weaker risk appetite everywhere as investors reprice sovereign risk globally. By the end, you'll understand why Japan's bond market matters more for your portfolio than most US investors realize, how the four-stage sovereign funding shock model reveals where stress concentrates when fiscal promises meet bond market reality, what 10-year yields at 27-year highs, 30-year spikes to 2.9%, and 40-year bonds crossing 3.1% signal about demand exhaustion at the long end, why the UK 2022 truss shock, 1990s Japan policy traps, and 1970s inflation expectations provide the pattern template, where today's JGB auction indicators and BOJ balance sheet constraints place Japan in the funding shock progression. How the Bank of Japan's impossible choice between inflation control and debt sustainability creates global spillover through FX markets and cross-border yield correlations. The 5 quiet signals showing stage 2 transitioning to stage 3 in sovereign funding stress. Let me show you the pattern that repeats every time a heavily indebted government makes unfunded fiscal promises that bond markets refuse to finance at existing yields. Stage 1, policy shock. A fiscal policy announcement, tax cuts, spending increases, stimulus packages, emerges without clear funding mechanisms. For heavily indebted sovereigns, this triggers immediate bond market concern. Markets begin questioning whether the government can service existing debt while adding new obligations. Initial yield pressure appears modest. Media coverage focuses on the policy merits rather than funding mechanics. This is the political debate phase where bond market reaction hasn't yet forced policy reversal. Stage 2. Yield spike and failed demand pockets. Long-duration bonds sell off as investors demand higher compensation for holding sovereign debt with deteriorating fiscal metrics. Auction results show weakening demand, lower bid-to-cover ratios, wider auction tails, increased primary dealer takedowns. Foreign buyers reduce participation first, followed by domestic institutional hesitation. The central bank faces pressure to intervene but holds back initially to preserve inflation-fighting credibility. This is where Japan sits today, yields spiking at the long end, auction demand showing stress, BOJ trapped between competing mandates. Stage 3, forced policy response. The central bank can no longer maintain neutrality. Either the fiscal policy gets reversed under bond market pressure, or the central bank intervenes to suppress yields despite inflation concerns. If intervention occurs, currency typically weakens as markets interpret yield cap operations as monetary dominance by fiscal needs. Foreign exchange reserves may be deployed to defend currency if weakness accelerates. Policy credibility erodes, whether the government reverses fiscal plans or the central bank. Subordinates monetary policy to debt sustainability. Stage 4, global spillover. Sovereign funding stress in a major economy creates contagion through multiple channels. Foreign exchange volatility spreads to carry trades and cross-border capital flows. Global bond yields rise as investors reprice sovereign risk across markets. Risk assets sell off as funding costs increase and uncertainty rises. Emerging markets face capital outflows as global risk appetite deteriorates. The initial local problem becomes a global repricing event because modern financial markets operate as interconnected funding mechanisms. Where is Japan today? Deep stage 2, with early stage 3 signals appearing in BOJ communications and foreign exchange intervention discussions. The system still functions, auctions clear. But the plumbing shows stress in ways that compound rather than resolve. In September 2022, UK Prime Minister Liz Truss announced a mini-budget featuring $45 billion in unfunded tax cuts. The policy aimed to stimulate growth through supply-side reforms. Within 48 hours, UK government bond yields gilts began spiking. The 10-year gilt yield surged from 3.5% to over 4.5% in days. The 30-year yield jumped from 4.0% to 5.0%, then briefly touched 5.1%. The mechanism wasn't gradual market adjustment. It was bond market revolt. Pension funds using liability-driven investment strategies faced margin calls as bond prices collapsed. These funds held gilts as collateral and suddenly needed to post additional margin or liquidate positions. The forced selling accelerated the yield spike, creating a doom loop. Higher yields, pension fund stress, forced gilt sales, even higher yields. The Bank of England, which had been conducting quantitative tightening and selling bonds from its balance sheet, abruptly reversed course. On September 28th, the BOE announced emergency gilt purchases not to stimulate the economy, but to prevent financial system meltdown. The BOE purchased $65 billion in long-dated gilts over 13 days to stabilize markets. By October 14th, Liz Truss reversed the tax cuts. By October 20th, she resigned as Prime Minister. The mini-budget lasted 38 days from announcement to full reversal. The bond market had effectively vetoed fiscal policy. The lesson isn't that Japan will experience identical events. The UK operated with much lower debt to GDP, faced different currency dynamics, and had a specific pension fund structure, creating amplification. The lesson is that bond markets enforce fiscal discipline when governments with substantial debt make unfunded promises. The enforcement mechanism operates through yield spikes that create financial instability, forcing either policy reversal or central bank intervention that subordinates monetary policy to fiscal needs. Japan's debt to GDP exceeds 230%, 5 times the UK's level when the Truss shock occurred. The proposed tax cuts and stimulus measures lack clear funding. Bond markets are signaling concern through long-end yield spikes. The pattern is recognizable. Unfunded fiscal promise, bond market doubt, yield pressure, forced choice between policy reversal or central bank subordination. Throughout the 1990s and 2000s, Japan operated under severe policy constraints. Government debt rose steadily as repeated stimulus attempts failed to generate sustained growth. The Bank of Japan pushed interest rates to zero, then implemented quantitative easing, buying government bonds to suppress yields and provide monetary stimulus. This created a trap. As the BOJ's balance sheet expanded, eventually holding over 50% of all outstanding JGBs, the central bank became the dominant buyer in the market. When the BOJ announced any reduction in bond purchases or discussed balance sheet normalization, yields would spike and the BOJ would quickly reverse course. The constraint became self-reinforcing. High debt levels required low interest rates to remain serviceable. Low rates required BOJ intervention. BOJ intervention increased debt held by the central bank. More central bank holdings meant less market depth and greater yield volatility whenever the BOJ stepped back. The government couldn't reduce debt because growth remained weak. Growth remained weak partly because the corporate and household sectors had learned to expect perpetual stagnation. This is the Japanification pattern other economies now risk. Once debt reaches extreme levels and central banks become dominant bond buyers, reversing course becomes nearly impossible without triggering the exact funding crisis the intervention was meant to prevent. Japan today faces an updated version of this trap. Inflation has finally emerged, not from growth, but from energy costs and yen weakness. The BOJ wants to normalize policy and reduce bond purchases, but government debt hasn't declined, it's increased. And now there are proposals for additional unfunded fiscal stimulus. The BOJ is trapped between inflation control and debt sustainability, exactly the impossible choice central banks face when fiscal dominance emerges. In the 1970s, advanced economies learned a painful lesson about inflation expectations. Once bondholders believe governments will inflate away debt rather than service it through fiscal discipline, they demand higher yields as protection. This becomes a spiral. Higher yields increase government borrowing costs, making fiscal discipline harder, increasing the temptation to inflate, further raising inflation expectations, pushing yields even higher. U.S. bondholders experienced this in the 1970s, losing 67% of purchasing power in real terms despite receiving every promised payment. UK bondholders faced similar destruction. The mechanism wasn't default. It was inflation eroding the real value of fixed nominal returns. Japan avoided this dynamic for decades because deflation, not inflation, was the dominant concern. But now inflation has appeared. If bond markets begin believing the BOJ will subordinate inflation control to government funding needs, Japanese bondholders face the same risk 1970s Western bondholders experienced: negative real returns through inflation despite nominal payment. This isn't prediction, this is pattern recognition. When heavily indebted governments face funding stress, they historically choose inflation over explicit default. The cost transfers from government to bondholders silently through purchasing power erosion. The 1970s weren't unique. This mechanism repeats whenever governments need to reduce real debt burdens and lack the political will for austerity. Japan's 10-year JGB yield reaching 1.3% represents the highest level since 1998, a 27-year high. This isn't random volatility. It's the market repricing Japanese sovereign risk in light of fiscal policy proposals and BOJ normalization attempts. The 30-year JGB yield surging to 2.9% is particularly significant. Long-duration bonds are most sensitive to fiscal sustainability concerns because investors must believe the government can service debt not just today, but decades into the future. When 30-year yields spike while short rates remain controlled, it signals doubt about long-term fiscal trajectory. The 40-year JGB yield crossing 3.1% compounds this signal. Japan issues very long-dated bonds precisely because low long-term rates reduce debt service costs. If the government must pay 3.1% on 40-year debt instead of the sub-1% rates of recent years, the long-term fiscal math deteriorates dramatically. A government with 230% debt to GDP cannot afford normalized yields on very long maturity obligations without either sharp fiscal adjustment or central bank intervention. These aren't isolated data points. They're the long end of the yield curve, screaming that current fiscal policy trajectory is unsustainable at current debt levels without either BOJ intervention or fiscal policy reversal. Recent JGB auction results show concerning patterns. Bid-to-cover ratios for long-dated bonds have declined from historical norms. The 30-year auction in December 2024 saw a bid-to-cover of 2.8, down from typical 3.2-3.5 range. The 40-year auction showed similar weakness. Auction tails, the difference between clearing yield and pre-auction when issued yield, have widened. Historical JGB auctions cleared with minimal tails, often 0.1 and 0.2 basis points. Recent auctions show tails of 0.5, 0.8 basis points, indicating weaker demand than dealers anticipated. Primary dealer takedowns have increased as a percentage of total issuance. When private investors don't absorb full auction amounts at expected yields, dealers must take larger positions. Elevated dealer inventories signal distribution difficulty and insufficient end buyer demand. Foreign participation, while historically low in JGBs due to currency hedging costs, has declined further. Domestic banks, traditional large buyers, have shown hesitation at recent auctions. Life insurance companies and pension funds, which need long-duration assets to match liabilities, are the remaining reliable buyers. But even these sophisticated institutions are becoming more price-sensitive as yields rise. The yen weakened to 157 to 158 per dollar in late 2024, levels that triggered verbal intervention warnings from Japanese officials. Currency weakness theoretically helps exporters, but creates imported inflation through higher energy and commodity costs. Japan's Ministry of Finance maintains foreign exchange reserves specifically for intervention purposes. Officials have made increasingly explicit statements about readiness to intervene if yen weakness becomes excessive and disorderly. This language typically precedes actual intervention. But intervention faces limits. Selling dollars and buying yen reduces foreign exchange reserves and can be quickly overwhelmed by market flows if broader yen weakness drivers persist. More fundamentally, if JGB yield spikes and BOJ intervention to cap yields is the cause of yen weakness, then FX intervention treats a symptom while the underlying disease, fiscal monetary conflict, continues worsening. The Bank of Japan owns over 50% of all outstanding Japanese government bonds, accumulated through years of quantitative easing and yield curve control. This massive balance sheet creates both power and constraint. The power. The BOJ can suppress yields by purchasing unlimited quantities of JGBs. The constraint. Doing so expands the money supply, potentially fueling inflation the BOJ theoretically wants to control. Additionally, if the BOJ owns most JGBs, secondary market trading becomes thin, reducing price discovery and increasing volatility when the BOJ isn't actively intervening. Recent BOJ communications signal desire to reduce bond purchases and normalize policy, but each attempt to taper purchases triggers yield spikes. The December 2024 bond market sell-off coincided with BOJ signals about potential March 2025 rate increase and reduced JGB buying. The BOJ faces an impossible trilemma: control inflation, maintain financial stability through low JGB yields, or maintain yen stability. It cannot achieve all three simultaneously. Choosing inflation control means allowing higher yields, which threatens financial stability. Maintaining low yields through intervention risks inflation and yen weakness. Defending the yen through FX intervention does nothing to resolve the fiscal monetary conflict driving the problem. When major economy sovereign yields spike, global bond markets reprice through multiple transmission channels. Japanese institutions hold significant foreign bond portfolios. If JGB yields rise, these institutions may repatriate capital to invest in now attractive domestic bonds, reducing demand for foreign bonds and pushing global yields higher. Currency hedging costs matter. If the yen weakens alongside rising JGB yields, foreign investors' currency-hedged returns from non-Japanese bonds improve. But if carry trades unwind due to yen volatility, leveraged positions across global markets face pressure. Cross-border bank funding connects markets. Japanese banks operating globally fund themselves partly through domestic deposits in JGBs. If JGB markets face stress, these banks may reduce cross-border lending, tightening global credit conditions. Risk sentiment matters most. When a major sovereign bond market experiences funding stress, global investors reassess risk across all markets. Risk-free rates rising in Japan reminds investors that sovereign bonds aren't actually risk-free. This reassessment typically shows up as higher risk premiums globally, higher corporate bond yields, lower equity valuations, wider emerging market spreads. The proposed fiscal stimulus package includes income tax cuts and corporate tax reductions intended to boost consumption and investment. Estimates suggest revenue loss around $5 trillion annually. For a government already running deficits and holding 230% debt to GDP, this represents additional borrowing unless offset by spending cuts or other revenue sources. Sane Takaichi, a prominent political figure advocating for aggressive fiscal stimulus, has championed these measures as necessary to escape stagnation. The economic logic has merit. Breaking deflation psychology and encouraging spending could generate growth that eventually improves fiscal metrics. But bond markets don't wait for eventual outcomes. They price current fiscal trajectory. If Japan announces $5 trillion in annual tax cuts without identifying offsetting measures, bond markets immediately question how this will be funded. The answer? What more? JGB issuance means more supply hitting a market already showing demand stress. This creates the classic fiscal monetary conflict. The government wants fiscal stimulus. The BOJ wants policy normalization and inflation control. Bond markets force a choice. Either the fiscal plans get scaled back, or the BOJ intervenes to suppress yields, subordinating monetary policy to fiscal sustainability needs. Here are 5 signals to watch through 2025-2026. Signal number 1, 10-year JGB yield sustaining above 1.5%. This would represent not just a spike, but a regime shift, indicating markets no longer expect BOJ yield suppression at current levels. Signal number 2, auction bid to cover ratios for 30-year and 40-year JGBs falling below 2.5 on sustained basis. This indicates private demand exhaustion requiring either higher yields or BOJ intervention. Signal number 3, BOJ balance sheet expansion resuming after attempted tapering. This reveals the central bank cannot actually step back without triggering yield spikes, confirming fiscal dominance. Signal number 4, yen weakening beyond 165 per dollar with actual FX intervention occurring. This shows currency stress from fiscal monetary conflict, overwhelming verbal intervention. Signal number 5, yield spread between 10-year JGBs and 10-year U.S. Treasuries narrowing toward parity or inversion. Historically, JGBs yield far less than Treasuries due to different inflation and growth expectations. Convergence signals global repricing of Japanese sovereign risk. Next episode, the Treasury buyer shift, how funding stress travels from one major bond market into the world's reserve currency system. When Japan's bond market faces stress, the transmission to U.S. Treasuries operates through channels most investors never see. Currency hedging costs, cross-border bank funding, and the repricing of risk-free rates globally. The pattern is documented. The sequence is clear. The only question is whether you recognize the sovereign funding shock before global yield repricing and risk-off dynamics force recognition through portfolio losses. This isn't about predicting the future. This is about recognizing when sovereign bond market plumbing operates outside sustainable parameters, and understanding what historically happens when heavily indebted governments make unfunded fiscal promises that bond markets refuse to finance.